Welcome to another video in our Taking Care of Business series. In this video I'm going to briefly look at franchising in Australia and its big business, with franchising contributing an estimated $128 billion to the economy each year. At last count there are more than 1,000 franchisors and over 70,000 franchisees employing more than 400,000 people in this country. By way of history, most early franchises were fast food outlets. However, they now span a wide range of industries, including real estate, childcare services, coffee shops, cleaning, home maintenance, and pet services, to name just a few. While there are several forms of franchising in Australia, the most popular type is what we call pure franchising. This is where the franchisee pays an upfront fee and is provided with an established business, including the license to use the business name and the trademark. The franchisee is allowed to run the business independently, and they usually own a specific territory. Classic examples of this model are fast food restaurants like McDonald's and Pizza Hut. Now, theoretically, as a franchisee, you're buying into someone else's business, including the brand, the IP, all the systems, processes, and marketing materials that you need. In a sense, you're buying a business in a box, but it's not that simple, because there are strings and legal red tape attached. A close examination of the agreement might reveal that the franchisee has to pay regular royalty fees, plus, at the end of the term, the franchisee may have no right to continue trading. The devil is often in the detail, so make sure you review the agreement very carefully. Now, franchisees do get some protection, as the franchisor must comply with the franchising code of conduct that requires them to provide the franchisee with a disclosure document and various other documents at least 14 days before they enter into the final agreement. This period is there to help the franchisee do their due diligence, but that can be tricky where the franchise has only been operating for a short period of time. The disclosure documents are quite detailed, and from a financial perspective they must include at least an estimate of the total costs involved in establishing a franchise, details of ongoing payments to the franchisor, earnings forecasts about the franchise based on reasonable grounds, and a summary of the most recent financial statements of the franchisor, or a copy of an independently audited statement verifying their solvency. So in summary, buying a franchise does not guarantee financial success. There are risks involved, and in the last few years we've seen some well-known franchises like Pieface, Wendy's, Eagle Boys and Krispy Kreme go into administration, so the risks are real. There are plenty of wonderful franchise success stories, and if you are thinking of becoming a franchisee, make sure you do your homework on the franchise and seek professional advice from an industry expert. There are numerous issues to consider, including the terms of the franchise agreement, your choice of business structure, the tax registrations, insurances, and accounting software selection. We can assist you in all of these areas, plus provide advice on HR matters, payroll, and the preparation of a business plan. On the other hand, if you're looking to franchise your business, we also have experience in this area. So, if you're thinking of buying into a franchise or looking to franchise your business, make no mistake, having an accountant who understands franchising can give you a serious competitive advantage. Talk to us today, and we invite you to book a free consultation to discuss your franchising plans. Until next time.